Welcome back to our second hour. On the line with us, Dr. Richard Wolff, the economist, co-founder of Democracy at Work, author most recently of Capitalism's Crisis Deepens, Essays on the Global Economic Meltdown, the website democracyatwork.info, or rdwolf with 2fs.com. You can tweet him at Prof. Wolff, as in Professor Wolff, P-R-O-F, Wolff, W-O-L-F-F, or at democracy@WRK. Dr. Wolff, welcome back.
Thank you, Tom. Glad to be here.
It's great having you with us. I'm seeing some weird behavior in the marketplace. Yesterday we were talking about this on the air. The yield curve seems to have flattened. That is, the difference between 2-year treasuries and 10-year treasuries has gotten very, very close. And when that yield curve flattens or even inverts, that's typically a sign of impending recession. And but the market is still, according to at least a number of market analysts that I respect, is still in, quote, bull market territory. It seems to me that the reason for this is that you've got all these investors, billionaires and wealthy companies, but particularly the billionaire class, who got massive tax breaks. These corporations got massive tax breaks. Actually, I think it's the corporate behavior. The corporations got these massive tax breaks, and they're using that money not to strengthen their company, not to build their company, but rather to buy back their shares to inflate their stock price so that the executives who are paid with, principally compensated with stock, the senior executives, get, jacked up incomes. I mean, they're just taking the money and run. And that is driving the stock market higher and will continue to until they've bought up all the shares that they can and things go back to normal. Does any of this make sense to you?
Yes, I would just add a couple of things to round the picture out, perhaps. Yes, they're taking their money, as so many of us predicted. They are not explicitly increasing jobs. The job creators have, in turn, figured out that they're better off and can make more money playing the stock market to enrich their prices of stocks and hence the pay scales they give themselves based on prices of stocks and so on. And so we're not going to get the big growth spurt that we had hoped for and that had justified the tax cut in the first place. All of that's correct. But I think you're seeing something else as well. I think you're seeing a growing number of investors, as well as the rest of the observers class, if that's what we are, beginning to recognize that this really is a long-in-the-tooth economic recovery. It only affected a small slice of the American society at the top, the very people who had been doing well before, the very people whose bad investments brought the 2008 crash. They've now been, quote-unquote, recovered. The rest of us really haven't, and that's not a sustainable arrangement. And so you're seeing investors, yes, running into the stock market, but they're also, and this is crucial, they are worried about the future. And that's why they're buying record amounts of long-term, 10-year and older federal treasuries, even though they're paying 2-3%, because that's a safer place to be when things get really bad than anywhere else over the next few years. So I think...
So is that why the yield curve flattens? Because
that's right.
I see.
People buy the long term to be safe over the next, say, 10 years. They're willing to settle for 3% from Washington over 10 years, and that makes sense if you think you're in for really a rough time between now and 10 years from now. And a growing number of very wealthy investors are now buying, if you like, this insurance. And that's why you're seeing the yield curve. The Federal Reserve is raising short-term interest rates because it's got to contain this overhang of money. But at the same time, the anxiety-ridden people who are worried about the Federal Reserve's raising interest rates and bringing the crash down, they have to protect themselves, so they are responding by buying long-term bonds. That drives down the rate, and then you get that flattening.
Right. And so if this is, in fact, leading us to a recession or a crash and a depression even, What role will the plunge protection team play in this? They were not around for 2007, 2008. They certainly were not around in 1929. Can they hold the, I mean, right now they're sticking their fingers in the holes in the dike, but when the dike itself starts to crack, can they hold that thing back, or should they, for that matter?
Tom, that's a great metaphor. I'm probably going to steal it from you.
Go for it.
In the months ahead. Yeah, look, I mean, everyone has to remember that we were told after the Great Depression that the Federal Reserve and the Keynesian economics and all the rest of it had learned the bitter lessons and knew how to control, how to anticipate, how to manage. And then we had 2008, which should have, for everybody else, been the final nail in the coffin of the belief that you can have the benefits of capitalism in some magical way without paying the costs of capitalism, and one of the biggest ones of those is instability. We don't know how to anticipate adequately. We don't know how to manage. That's why the crash of 2008 was so terrible. That's why we're still in the after effects of it 10 years later. So to be suddenly confident that in this unprecedented time of monetary expansion, of a world economy differently organized than we've ever seen it before, with parts of the world that were marginal, like India, China, and Brazil, now at the center of the game, to imagine that suddenly the Federal Reserve will know exactly what to do, how, when, and where, that's nuts. That's the kind of stuff that is written in books by people who used to be heads of the Federal Reserve, who need to tell themselves, with some truth, by the way, that it could have been even worse without them. But the bottom line is we are in uncharted waters with a very unstable economy, having gotten to a very weird place because of all the adjustments to our failure to prevent the 2008 crash.
Yeah, I realize, and we've had this conversation before, and we will in the future, that larger macro solutions are really necessary at the end of the day. Worker-owned cooperatives, stronger unions, things like that. But specifically to this point of the way that companies and the executives of companies really are manipulating stock prices in order to increase their own compensation. Wouldn't a short-term or an important stabilizer for capitalism in this case be to do what I believe, and correct me if I'm wrong, I believe that on the European stock exchanges, companies that are European-based and listed on the DAX and on the VIC or whatever they are. I'm sorry, I don't know the names of all the European stock exchanges, but in any case, that they are still following the rules that we had before Reagan that forbade executives, senior executives in companies, decision makers, from being compensated with stock or having stock prices tied to their compensation. And Reagan blew up those rules. If we were to bring those rules back, might that not dramatically reduce the kind of risky behavior that we're seeing?
Look, it might, but let me throw your own metaphor, your good metaphor, right back at you.
Okay.
If you put your finger in one hole in a holy dike, the chances of another hole popping up any moment, confronting you with the fact that you have only 10 fingers and this dike may have more than 10 holes in it, this is what you're seeing. Yes, it could help, but you're leaving the power to make these kinds of decisions in the hands of private owners of vast wealth who are sloshing around trying to figure out how to make money. Let me give you just one example. Even if you did control corporations, executives from using profits to buy shares, et cetera, the Financial Times today has a lead story explaining how, once again, subprime mortgages across the United States are being bundled into very, very risky securities, which are being marketed. And as you read through the story, you discover that people are very nervous about the low rates of return they can get, so they're taking bigger and bigger risks.
Right.
We've heard this story for 200 years of capitalism's history, and the story never ends well. And so even though you doing this thing or that thing. If you don't go to the systemic problem, you're playing a game with yourself, which psychologists call denial.
If you look at a 100-year graph of the U.S. stock market, there was a massive stock run-up in basically 1925, 26 through 29, and where the market went from, like, I don't remember specifically, but it was like something like 30 to 140 or something like that. I mean, it was huge. I'm sorry?
No, exactly right.
Yeah,
exactly right.
And then if we look at the last 20 years or so, in this 100-year thing, if we look at this kind of time period, we've seen the market. It was it's over 24,000, I think, now, or 23,000. It's peaked at 24,000.
Same story.
It was at 13,000 in 2008, and everybody thought that's insane. It was in 2000 it was around what, 5,000, 6,000. I mean, this market has just exploded in the last decade and a half. Are we looking at a very similar situation to 1929?
I seem to, history would suggest that it would be absurdly crazy of us not to ask that question and to at least admit that one ought to be extraordinarily careful about the kinds of economic policies one pursues, given the record you've just cited, given what has happened every other time. What we have instead of carefulness and prudence and caution as our guides, we have a literal kind of wild cowboy capitalism in Washington, in which we're going to give the corporations who don't need it after 25 years of rising profits and stock values, that the last thing on earth they needed was a 40% cut in profits taxes. But the ideology is such that we are being wilder at the very moment that the history teaches the caution you just summarized.
Brilliant. Dr. Richard Wolff, thank you so much for dropping by today.
Thank you, Tom. Have a good weekend.
Great talking with you. democracyatwork.info is the website.
This is the Thom Hartmann Program.
And, of course, you can tweet Dr. Wolff at Prof. Wolff or at democracy@WRK and rdwolf.com also.